Hi, everyone. Thanks for joining me today for our Big Decisions webinar. My name is Brenda Rolli, and I'm an accredited asset management specialist with Provident Financial Consultants here in Oshkosh, Wisconsin. Each stage of our lives will present us with a unique set of challenges. At Provident, we feel truly privileged to work alongside our clients and help them as they prepare for these transitions through some of the most significant stages of their lives. The webinar today will consider the different issues and challenges we may face as we approach many of life's milestones. One of our first and exciting decisions we make is the decision to get married. Here is a financial checklist for married couples. Let's begin with getting your finances in order. Now, in my opinion, this should be discussed before marriage to be sure you're on the same page and to discuss any ideas that differ. You don't want to start your marriage with disagreements about finances. The two of you should put a plan together to create a realistic budget and reduce or eliminate any bad debt. Establish an emergency fund and discuss whether or not you will have joint or separate accounts, which we will discuss in more detail shortly. Once married, you'll want to update your driver's license, passport, and other documents if you're changing your name. Consider making your spouse the beneficiary in all accounts. Review your health insurance options. Be sure it covers relevant medical expenses, including prenatal care. Consider updating your tax filing options. This is one thing a lot of couples forget to do. Now that you're married, you may need to change that to married filing for jointly, or if you want to or need to, keep it as single, but something that you do want to review. You may also need to create a will and purchase life and or disability insurance. Now, as we said, we'll discuss a joint or separate bank account. There are pros and cons to both arrangements, and the decision is ultimately a personal one. Let's look at three different approaches. One approach, what's mine is yours. Joint accounts make the household's financial picture clearer, but may place the burden of money management on one person. However, at the same time, it does give you a clearer financial picture and will make joint expenses easier to handle. You do, on the other hand, have less privacy and independence. So it can be very hard to surprise your spouse with a gift when you have joint accounts. Another approach, let's give each other some space. This is a combination of joint and separate accounts. This will help maintain some privacy. It places a burden of money management on both people. However, it does provide a less transparent financial picture and lack of clarity over who pays which bill. The final approach we'll look how independent we are approach. This is where you maintain separate accounts, you maintain privacy and independence. It does place the burden of money management on both partners. However, it creates an opaque financial picture, and paying shared expenses could become difficult. At some point, couples may choose to add to their family. While very exciting, there again are financial issues to consider. Let's review the financial checklist to prepare for a new baby. Pre-delivery planning should include understanding your health insurance, prenatal care, childbirth classes, maternity clothes, hospital costs, what your policy will pay for and what will be out of pocket. You'll also want to plan for maternity, paternity leave, and understanding your company's policies and state laws regarding this. You'll want to draft your baby budget. Expenses in the first year can be between $10,000 and $20,000 a year. You'll also want to choose a pediatrician within your insurance network. Now, I'm also going to include in this plan for child care. It shows on our slide that is within the first 30 days. However, there can be a waiting list for the child care option you choose. So if that is the case, you want to get on that waiting list prior to having the new baby. If you are planning to rely on family, you will want to make sure everyone is, again, on the same page with expectations. While you're in the hospital, you will order your birth certificate and social security card. Then within the first 30 days, you'll add your child to your health care insurance. And again, plan for child care should have been something that was done previously. After the first month, consider opening a 529 plan and write or adjust a will. It is never too early to start preparing for college payments. So with that in mind, let's look at 529 plans as we just talked about. A 529 plan can be set up by anyone for anyone. A relative, a friend, even you can be the beneficiary. There is no limit to the number of plans you can set up. Also, anyone can contribute to the 529 plans. So grandparents should be made aware that you have set up a 529 plan, as they can contribute at any time to them. There's no limit to the number of plans you set up. So if you find out grandparents on the East Coast set one up, you've set one up, it's okay. It doesn't matter how many plans are set up for your child. There are essentially no contribution limits. However, remember, there could be a gift tax consequence if your contributions exceed $15,000 per person per year. Most plans allow you to set it and forget it, which means automatic investments linked to a bank account for a payroll deduction plan. There are also tax advantages to contributions to a 529 plan. The earnings grow tax-free and will not be taxed when the money is taken out to pay for college. In addition, there are over 30 states that offer full or partial tax deduction or credit for 529 plan contributions. On the federal side, they are not tax deductible, but on the state side, you could receive a full or partial tax deduction or credit. There's no border control with 529 plans. You are not restricted to plans operated by your state or to attend universities in your home state. The market is competitive and you may find another plan you like more. However, remember this, if you choose a 529 plan outside of your state, you may lose the state tax deduction or credit. If you have questions or would like more information about 529 plans, please contact us. We are happy to assist. Not every couple dreams of owning a home, but this could be your next milestone. If you are deciding to buy or rent, let's look at some of the pros and cons. It's not as simple as comparing the monthly rental fee with the monthly mortgage rate. There is more involved. With renting, you can find a house you want, if you can find a house you want, in a neighborhood that you desire that is available to rent. It may be an option. However, it may be easier said than done. Next, are you okay with potentially having to move out of the home should the landlord decide to sell the property, raise the rent, or rent to another occupant? On the other hand, buying offers you potential stability. You don't have to move unless you choose to, and the ability to own an asset when you have paid off the mortgage is also a benefit. Buying comes at a high cost, however. Unlike with renting, you often need to put down 20%, and there is an opportunity cost to that money. meaning the potential rate of return if that money were invested rather than putting down using as a down payment. Also, you have to pay interest and principal plus property taxes and any inevitable maintenance costs. So again, it really depends on what you want for your lifestyle. Once you've decided that buying a home is something that fits you and your family, you should begin with a checklist. First thing you should do is obtain a credit report. After that, make sure you do not become house poor. I'm sure many of you have heard that term, meaning that you have more in your house and your payments take up a bigger percentage of your paychecks with very little room to afford anything else. So you want to set a budget, what the monthly payments can be, which should roughly be about 33% of your monthly net income. After that, you should line up the down payment. Between the third and fourth step now, I would add a pre-approval. Most agents will want to know you are pre-approved before spending time showing you homes, only to find out that you're not approved and aren't able to afford the home that she or he has been showing you. Once you do that and you find a home, then you make your offer, secure your loan, get an inspection, and close the deal. When deciding to obtain the loan, you'll have another choice, as if deciding which home to purchase wasn't a big enough decision. Now you will need to decide, should you borrow money for 30 years or 15 years? A 30-year mortgage will cost you more over the life of the loan. The primary driver is time. The monthly payment is fixed. The portion going to pay interest and the portion going to pay principal changes over time. In the beginning, because the loan balance is so high, most of the payment is in interest. But as the balance gets smaller, the interest share of the payment also declines and the share going to principal increases. In a 30-year loan, that balance shrinks much more slowly, meaning the homeowner pays more interest over time. Now, this example shows $1 million house with a $700,000 mortgage. I don't know about you, but this isn't a realistic example to me. So why don't we look at something more realistic? And I'll give you some numbers here for a house worth $300,000. And that's the purchase price. A 20% down, you're going to have $60,000 down and you will finance $240,000. Looking at a 30-year fixed rate, which would be about 4% today, your monthly interest and principal payment would be $1,145.80 a month. $172,486 is interest. Over the life of the 30-year loan, you will pay $412,486 for that $240,000 loan. On the other hand, a 15-year fixed, which currently would be about 3.4%, your payment goes from $1,145.80 to $1,703.96 a month. So it is quite a jump. Your interest goes from $172,486 down to $66,712. And the total amount paid is now from $412,486 to $306,712. I think the big aha moment there and where eyes widen is when we talk about the difference in interest from $172,486 down to $66,712. So again, the driver is time. You're paying down that principal much faster. So more money, more of your payment goes to the principal. Now, the next decision, once you decide 15-year or 30-year, is should you use a fixed rate or a floating rate? We previously looked at the fixed rate. However, floating rate loans are offered. A fixed rate mortgage charges the interest rate that does not change throughout the life of the loan. That total monthly payment remains the same, making budgeting easy for homeowners. A floating rate mortgage, however, varies over time. The interest rate is set below the market rate of a comparable loan and will remain that way for a fixed period of time. In this example, the 5-1, it would remain set for 5 years. Afterward, the rates are going to adjust. If interest rates fall, then the interest rate on the loan will fall as well. However, the other side is if interest rates rise, such as the case now, then the interest rate on the loan is going to rise. So for example, if you had an adjustable and your loan is after the 5 years, you're at say 2.875, which is something we could have, had about a year or two ago. And currently your rate is going to adjust. You could be looking at an increase in payments because your new rate would be 4%. Not only does this rate adjust at the time the 5 years is up, this adjustment occurs annually over the remaining term of the loan. So in this example, every year your rate is going to adjust for the next 25 years. One way to significantly reduce the total interest burden of your mortgage and the number of years required to pay down your mortgage is to simply make an extra monthly payment per year. Why would you do this? Because as you pay more, the balance gets smaller, the interest share of the payment also declines, and the share going to principal increases. One way to do this is to make your payment biweekly rather than monthly. Many banks allow you to set this up automatically. Using our $300,000 home purchase and a mortgage of $240,000, if you remember, the monthly payment is $1,145.80. If we pay $572.90 biweekly, the total interest paid over 30 years is $145,422.84 rather than the $172,486.82. And the loan is paid off in just under 26 years. Our next topic, should you buy or lease a car? Cars are purchased sometimes for practical reasons, while for others, there are emotional reasons to purchasing a car. But on the financial side, does it make sense for you to buy or lease a car? If you are going to keep a car after 3 years, let's look at our basic example in the top part of the screen. Buying the car, putting $2,000 down, you have payments for 3 years of $590 a month. Your total cost is going to be $23,240. Now remember, you do have maintenance for your car for those 3 years. If you lease and then buy the car after 3 years, you'd still have the $2,000 down. Your payments would be $189 for 3 years. And at the end of the 3 years, you would buy that car for $17,000 in this example. You would have a total cost of $25,804 plus miles and wear and tear on that. In the second example, we're going to look at buying or leasing, but we don't keep the car. We trade it in either when we sell it, or we are perpetually leasing every 3 years. So in the first example, we're buying it. We put the $2,000 down, 3-year payments of $590 a month, and we turn around and sell it for $17,000. So your total cost was $6,240. Of course, your maintenance is in there. Leasing, you'd put the $2,000 down, 3 years of payments, and now you turn the car in and you can lease another car, your total cost was $8,804. So again, this is a very basic example to give you an idea of the difference. However, there are other pros and cons to it. While both of these examples, it looks like purchasing a car would be financially the better choice, there are cons to that. You do have higher monthly payments. You do have selling the car outright, depreciation in the value, but you do eventually own that vehicle. And you have the unlimited miles, which is definitely one thing you need to consider when leasing a car. The other example of trading it in or leasing a new car after 3 years, you never own the vehicle. You could be charged for wear and tear in excess of normal wear and tear. You do have higher insurance premiums because you're always getting a new vehicle. On the other hand, again, there's lower payments. You get a new car every 3 years and you do have lower repair costs. So some things to consider, and it's going to depend a lot on miles driven. One of the first issues we talked about back in the decision to get married is the need for insurance and creating a will. We believe households have to prepare against 3 major contingencies that can devastate the finances of any household. Number 1, if you can no longer work due to injury or illness, do you have disability insurance? Number 2, if you die too soon, how prepared are you? Have you written a will or a trust? How much life insurance do you have? Will your spouse and children be okay financially? And number 3, you can live too long. Do you have enough money saved? What happens if you need full-time care? Can you afford to live in an assisted living facility? Let's break down this journey. Preparing an advanced healthcare directive, also known as a living will, that expresses in writing your desires regarding medical treatment and end-of-life care should you no longer be able to express your consent. Assigning a power of attorney to act on your behalf on all legal or financial matters is something that you should also have in place. This document can be in effect at a trigger point if something were to happen to you, or it could be in place at any time. Purchasing long-term disability insurance, when we think of purchasing this, as a general rule of thumb, you want to only purchase between 60 to 70% of your salary. Because if you purchase this plan and you make the payments outside of, say, for instance, an employer plan, the benefits are not taxed. Make sure when you're purchasing disability insurance, however, that it cannot be canceled and that it pays out if you can't perform the duties of your current occupation. This is known as an own occupation policy. If you don't have an own occupation policy, the insurance company could require you to get a job, any occupation. So you don't want to be forced to do that. When we talk about insurance, in our view, the basic rule for all kinds of insurance is bear the risks that you can afford and insure the risks you can't afford. For example, you may be able to afford to lose jewelry, but you may not be able to afford to lose your home in a fire. You may be able to afford to replace broken glasses, but you may not be able to afford months of medical bills. You may not need to buy collision insurance on an older car, but you do need to buy insurance on your life were something to happen to you. When we talk about life insurance, there are 2 types of life insurance that we generally look at, and that is term life versus whole life. They each have potential advantages and disadvantages and may be appropriate for different life situations. Term life insurance as I would describe, is the most basic type of insurance, pure insurance. It is going to insure against one thing. So it may work well for very specific periods, like the remainder of a child's education or providing for a spouse during a critical year, but it does expire. So you usually purchase this up until age 65. And at the end, the premiums you've paid, hopefully you've never had to use it. It acts just like insurance. The policy is done. Whole life insurance may be more appropriate, but more expensive for individuals seeking insurance that is permanent. Although the costs of whole life insurance are typically higher, it does build up cash value that may offer savings, and that may be something that certain individuals will want to look at. If you want more information about the differences of life insurance and what may be appropriate to you, as always, give us a call. We are happy to help with that. So once we talk about life insurance and decide even which type, how much do you need? You don't buy life insurance because you're going to die, but because those you love are going to live. And that quote is very true. A simple calculation when looking at insurance could be, in this example, your annual salary times the number of years to replace it, a mortgage balance, plus other debts and possible future needs for college costs, funeral costs, and then you deduct savings and any existing funds. Again, this is a very simple calculation, but it gives you an idea of how you could start looking at it. There are many more variables that go into calculating the amount needed. If we look at this example with Jane and John, they have savings of $20,000, college funds, $10,000, a mortgage, and car loans. They're both 48 years old and have 2 children, ages 8 and 5. So in this example, you include their mortgage, their debts, future needs, less savings, and less college funds already in place. And you can see the number that they're looking at. But again, there are other variables that do come into play with that. So any questions, feel free to reach out to us and we can help you. We covered many of the big financial decisions you will face as you approach some of life's biggest milestones. We started with the marriage checklist, talked about the baby checklist and buying and renting a home, buying or leasing a vehicle, and then ended with estate planning and insurance. I hope you found this very informative. And again, if there's any questions, please feel free to reach out to us. Thank you for joining me today. I hope I've given you some food for thought when it comes to making some of the bigger financial decisions that you may face either in the near future or further down the road. If you have any questions, please email us at info@providentfc.com. Thanks again. I hope to see you for our webinar next month.